All right, so in this video, I'm going to talk a little bit about cash budgets. So when you start making plans, one of the things you need to do is look at a cash budget. And this might actually be more important than an income statement if you're looking at a startup business or something of that nature, because you can actually show income and run out of cash if you haven't collected on your sales or things like that. So a cash budget could actually more dictate your success or failure as a small business in particular. And for larger businesses, we still have to do this to make sure that we aren't going to run into trouble. So let's talk about what a cash budget is doing. So basically, a cash budget is showing the planned inflows and outflows of cash. So we're looking at over the next, say, 12 months, we're looking at the money we expect to have, the cash we expect to have coming in, the cash we expect to have going out. And let's look at kind of what the effects of this are and how this is all playing out. Now, in order to do this, you are going to have to make really kind of a fundamental key assumption here, and that's going to be your sales forecast, because that is going to affect a whole lot about what you think is going to be going on in terms of cash coming in, because we hope that you are actually getting cash at some point from your revenue, your sales. So if you're trying to figure out a sales forecast, there are a couple different ways that you could arrive at a sales forecast. You could have sort of an external based forecast or an internal forecast. So let's talk about that a little bit. So an external forecast is basically a kind of a top-down approach. So you look at external circumstances like what's going on in the economy, what's going on in the industry, what's going on amongst my competitors, and kind of work your way on down. So you're starting externally and then working your way down to your company to determine, what's an appropriate sales forecast. And then obviously there are some significant merits to that because you're looking at things like, well, what are the economic circumstances? If you're on the edge of a recession or you're in a recession, that's certainly going to affect what's going on with your business in terms of cash and things like that. And virtually every case, right? So basically what that would mean is I need to be thinking about those kinds of things. Also, industry trends, that matters. I mean, if sales are slumping in the industry as a whole, well, that's probably going to affect your business too. And so looking at those external pieces to kind of generate a sales forecast makes a lot of sense. And that's called the top-down approach. You're talking, kind of starting from the big end of the economy as a whole, and then working your way down. Now, there's another way to do it, and that's an internal forecast. That's a bottom-up approach. So this might be where we start looking at within the company on a product-by-product basis, or service by service basis, and look at what's going on with our sales in those different areas. What are the trends in the sales in those different areas? If I'm launching some new updates or upgrades or things like that, what do I think that's going to do to the sales? And I build up from all those pieces an aggregate sales forecast. And there's some benefit to doing that too, because you're factoring in new product launches, new features, all of those kinds of things, right? Trends at the individual product or service level, et cetera. So really, if you're looking at generating a sales forecast, probably it makes sense to do some sort of combination of both, where you're factoring in bits and pieces of both that external and internal forecast to arrive at a final ultimate sales forecast there too. Now, once I have a sales forecast, that's going to tie in with sort of the general format of a cash budget. So the general format of a cash budget is going to be, I'm going to start off with a beginning cash. So this is the amount of cash that I've got essentially to start a period, whatever the period is. And then I'm going to look at the total cash receipts. And this is going to be the total amount of cash that I expect to have coming into the business during the period. And then I'm going to look at total cash disbursements, the total amount of cash I expect to be leaving during the period. And then I'm going to look at, as a result of that, the ending cash. And so we're going to look at, I started here. This is the amount of cash that's coming in. This is the amount of cash that's going out. Therefore, where would I end the period in terms of cash? So let's say I end the period at $1 million of cash for my business, because maybe I'm a pretty decent sized business. I got $1 million of cash. All right, then I'm going to compare that to the target or minimum cash balance. So let's suppose that my target or perhaps a minimum cash balance is $750,000. So meaning that basically I've assessed it, I concluded I really should not drop below $750,000 in cash, or it puts me in a very dangerous position where I might have trouble meeting my bills, through the next month, something like that. So if that's the case, if I've got $1 million in there and my minimum is 750, I've got $250,000 extra, right? And so basically I have excess cash available. And so in that case, theoretically, I could do something with that amount of cash, invest it somewhere else, et cetera. Now, on the other hand, what if my required amount was, or the amount of cash that I'm expecting to have is $1 million at the end of the period? Let's say my required amount or minimum is 1.5 million. So I'm 500,000 short. So I'm expecting to end the period with 1 million. I really need to have 1.5 million to make sure that I'm not going to have any trouble paying my bills over, say, the next month. I'm $500,000 short. And that's where we get the idea of required financing. So one of the whole reasons we do a cash budget is to figure out, am I going to have extra? Am I going to be short? Where am I going to be? Because depending on where I'm going to be affects, and do I need to go out there and try to get some more money? Because I don't want to get partway through a month and all of a sudden I don't have enough money in the account to pay my utility bills as a business, right? That's a problem. So I'm kind of trying to project out the money that's coming in, the money that's going out, how much cash I've got to start with. Let's make sure that I'm not going to run out of money. And so I might do a cash budget over the next 12 months, but do monthly budgets. And if my business is seasonal, then it could actually fluctuate a fair amount from month to month, depending on whether it's a good month or a bad month, et cetera. Good time of year, bad time of year. And ultimately, what I'm trying to track there is, do I need funding at any point during this period of time, or am I going to be generating excess cash that I could go invest somewhere else? What am I observing in my projection here? And so that's why I have this note here: is there a shortage or surplus of cash? If you've got a surplus, that sounds great, but obviously, if I've got too much of a surplus, it raises questions about, am I being efficient in using my assets? Maybe I ought to put that cash to work somewhere else. But if there's a shortage, well, I better be thinking about how I'm going to address that shortage before I hit it, and all of a sudden I don't have money to pay my utility bills as a business, right? Now, one of the things that you could then evaluate is, if I've got all these projections, I'm trying to figure out, well, do I have enough? Do I not have enough? One thing you could look at is something called scenario analysis. And the idea behind scenario analysis would be to try different scenarios to see what would happen. So for instance, I started off with a sales forecast. What if I have a fantastic year and sales wind up coming in 20% each month higher than I thought? Let's run the numbers, see what happens. Probably that means I'm going to have a lot more surplus cash. On the other hand, what if I have a situation where I slide into a recession and sales drop by 10% for the year? Well, if that's the case, let's run the numbers on my sales forecast. That's going to affect the receipts that I'm expecting. And let's see what that does in terms of, do I need more cash, or do I have excess cash? And so you can evaluate, what would happen in these different scenarios. Because if it looks like, hey, if I have a little bit of a downturn, all of a sudden I'm going to find myself in a bind where I don't have enough money to pay off some debts that are coming due in 6 months, because that would be a cash disbursement, then I need to start thinking about that now to make sure that I have the money to pay it off. And that's kind of how this ties in with the financial planning. We're trying to map out the inflows and the outflows of cash over maybe the next year or so, to ensure that I don't run out of cash at some point. Because if I run out of money, I'm going to have a real problem paying bills and so forth. So that's kind of where the idea of the scenario analysis is coming in. We try different situations and see, what does that do? Now, that also brings up the topic of shorter term cash budgets. So one of the things that's worth noting is some businesses have much more stable and predictable cash flows than others. And if you have really stable, really predictable cash inflows and cash outflows, then creating a cash budget starts getting a lot easier. It's a lot easier to kind of just have your ending cash basically stay right there at that target or minimum cash balance. Easy peasy, right? Wonderful. But if I'm dealing with a business that has very erratic cash flows, maybe demand can be very erratic, or some of my costs are very erratic, then what can happen at that point is there's a lot of uncertainty around what's going to be going on. And that may mean that I might need to do a shorter term cash budget to try to address that. So scenario analysis may help me to a point, but maybe what I just flat out need to do is a shorter term cash budget and focus more on 1 month at a time or something like that, to make sure that things are headed in the right direction. But recognizing that I just may not be able to plan very effectively over a longer period of time, because my cash inflows and outflows are just much too erratic, because my business is not as stable, my sales are not as stable, and so forth. So that would be kind of how you would address a cash budget in a situation where your inflows and outflows are much more erratic. You might just use a shorter time frame and do a lot more separate projections as time progresses. Okay, hopefully this video has been helpful. Thank you so much for watching, and have a great day.